Okay, welcome everyone to what we're calling this is game one of the Friday doubleheader of the Anderson Report. I have been away for about 4 days, and clearly we had a very, very full week of economic data, and we also had a very full week of crazy stock market activity. So I thought that it would be in everyone's best interest to do one show on the economy and one show on the stock market. And we're going to start with the economy, give everybody a break, and then come back at 7 o'clock and talk about the stock market. And there's plenty to talk about on both topics. There was a lot of the economic data was clearly let's say, highlighted by the jobs report that came out early this morning. But there certainly was a number of other, um, mostly all positive pieces of data on the economy during the week. So, welcome everyone to the Anderson Report. I have not been on since a week ago today. And this is my YouTube channel, The Anderson Report. If you are watching and are a new watcher, please subscribe. Please hit the notification bell next to the subscribe banner on YouTube. And also, you can bear with me a minute just while I get one other thing set up. You can like the show. We certainly appreciate likes and pass it around to all of your friends. Anyone who you think might be interested in a much, let's say, richer play by play of the economy and the stock market from what you might get through your uh, financial news channels or from other um, alleged economic slash stock market podcasts. So we are just going to put this up here so I can monitor what's in the chat. We'll move it off here so the glare won't get too annoying. And we're going to start with the beginning of the week. And of course, look, there's plenty to talk about in the stock market. We're going to come back and talk about that at 7 o'clock. I'll, touch on a few basics of it. I realize that not everybody's going to watch both shows. I was toying around with how to handle it. And then I got the feedback from a couple of people um, that really like to watch the show and some of whom are, let's say, uh, potential rising stars at a couple of financial news networks. Um, and they said, well, Eleanor said, well, that's great because I can watch it I'm going to watch it at 5 o'clock. I'll watch the other replay later, but I'm going out to dinner. Today is the first day of indoor dining opportunities in the state of New Jersey with a capacity constraint, I believe, of 25%. We'll see how that goes. But bear with me just a minute. Excuse me. Okay, so we started out the week with a stock market that was just on fire, a very strong finish to the month of August. And even on Monday and Tuesday, markets were Um, to say that they were ebullient would be probably an understatement because we had stocks that just new highs for the Nasdaq and the S&P on Monday, and then even more exaggerated new highs on Tuesday, almost kind of capped by Zoom media in the world of Zoom conference calls and Skype conference calls and Microsoft conference calls. Zoom media is a stock that a lot of people probably weren't familiar with until the COVID shutdown started and everybody started doing a lot of streaming of their conference calls, etc. Zoom media rallied 40% on Tuesday, and that's a company that was already up hundreds of percent year to date. I'll get into that a lot more um, at 7 o'clock, but I just wanted to give a little bit of a backdrop on the market. Clearly, we had the big sell off on Thursday. Really, nothing more than some long overdue profit taking in a lot of stocks that were just wildly extended to the upside. I'm not going to use the term bubble and bring back memories of either the global financial crisis or really the most recent bubble was the internet bubble 98 through 2000. But stocks, particularly the mega growth, mega cap tech stocks, were just really overextended with gains at a rate that could not be sustained through the end of the year and probably even through the end of the quarter. And it's almost historic that when you have a strong 5% plus gains in July and August back to back, you usually have at some point in time a sharp correction in the market in September. So we had a 3 to 5% correction, depending on whether you're looking at the S&P, the Dow, the Nasdaq. We had a 3 to 5% correction on Thursday. We had a one point a very sharp correction also today. Then there was a reversal in the afternoon. We gave back a touch during the last 45 minutes. But I would say for most people who are watching the market today, the reaction at the end of the day was, okay, I'll take it. It's certainly a lot better than it looked at 11 o'clock this morning. But getting to the economic data, we started the week really with the ISM manufacturing report on Tuesday. And it was pretty much a report where just everything in it was very positive. And that really set the tone for the rest of the week for a number of other manufacturing reports from the industrial or construction sectors. Of course, the ISM services report and also the jobs report. So we had kind of had a combination of a heavy dose of data this week on manufacturing activity in the economy and on jobs. Now, the manufacturing report for August came in at 56.0. That was a noticeable uptick from July when it came in at 54.2. 3 months now above 50. 50 is the expansion contraction threshold, where if a number comes in above 50, the economy is expanding. If it comes in below 50, the economy is contracting. But keep in mind, these are sequential numbers. And this means expanding after the very, very sharp contraction we had in March and April. Still a good report for the manufacturing sector um, on Tuesday with the ISM manufacturing survey. All of the metrics within the report were very positive. New orders uh, came in at 67.5. That was an uptick from July, where it came in at 61.5. The production index came in above 63. That was an uptick from July of a little over a point when it came in just above 62. Came in at 63.3 for August, 62.1 for July. So even though a lot of people thought that the economy was starting to cool off a little bit in August, we did not see it in the ISM um, manufacturing report. We saw an economy that was still expanding on both new orders and production. The employment index increased from 46.4 to 44.3. That I think is consistent with the improvement that we've had in the weekly claims numbers uh, throughout most of August, although with one stall right in the middle. And then the prices paid number took a pretty healthy jump to 59.5 from 53. That shows basically a little bit of pricing power in the among suppliers in the manufacturing chain. Pricing power, when you have prices going up, that is basically a sign of an expanding economy. Maybe where some supplies are tight, maybe where suppliers need to do fewer quantity discounts and fewer bulk discounts, and for prices paid to jump by 6 percentage points to above 59 from just above 53 is a pretty healthy jump. I would say that people should maybe have their expectations for September uh, maybe tap down just a touch. Not that I don't think September is going to be a good month for manufacturing. I think it is. But when you've got new orders running at 67.5% and prices paid running just below 60%, those are very strong numbers. And I'm certainly think that we'll have good numbers in September. I think some of the internals of this report surprised a few people, although it was only a beat of less than 2 points overall, 56.0 versus 54.2. Um, it was a strong report, pretty much any way you look at it. And one other component that's the only component of the report that was down, which is actually a positive indicator also, was the inventories index, down to 44.4 from 47.0. Now, the reason when the inventories index goes down, or if you get an inventories component in other reports, a low inventory level is actually a positive forward indicator because it means that there are fewer goods, raw materials, parts, finished goods, whatever the classification is. There are fewer goods or or parts of goods or raw materials in the pipeline that when orders start to come in, all they have to do is take inventory off the shelf. So for inventories to go down just means that there's the potential for that much more pent up production going forward. So ironically, the one component of the report that declined was the inventories index, and that's actually a positive also. So this is a good report all the way around. Um, and then we also had a construction spending report. The headline wasn't that great. July up 1/10%. June came in at a revised minus 0.5% versus and it was revised to minus 0.5% from minus 0.7%. The construction report is one of those reports, along with factory orders, that has a full month lag to it. In other words, This report came out Tuesday, September 1st, but it wasn't for August, it was for July. So it is a report that comes out with a full month lag. The July report, and I don't think it would surprise anyone that within the construction spending report, the bright side of it was in residential construction. We've talked numerous times about the housing market being very strong for a couple of different reasons. Interest rates extremely low, just below 3% for mortgage rates. Mortgage rates just below 3%, very low, historically low. And uh, people looking to move out of big urban areas to the suburbs or even beyond, tight housing supply. That's those three factors are all driving a, a strong uptick in residential home building, housing, residential construction, whatever you want to call it. That part of the construction spending report was positive, even for July. The commercial part of the report was negative, which makes sense given that retailers are struggling significantly. They're not really looking to open new retail outlets right now. You don't have places like Starbucks and even Chipotle and food chains and or retail chains, uh, coffee chains, whatever types of commercial businesses might be in an expansionary mode if they had a product line that was in the sweet cycle. Uh, but with just a lot of people still not going out, the COVID stuff still being a hangover on people going to out to shop, out to buy stuff in stores, et cetera, et cetera. The commercial business down. The other two parts of the report that were weak: educational spending down 3%. Look, a lot of schools, they don't know how many people are going to be, you know, um, they don't know how many people are going to be attending in person. Some of them are going to split, do a hybrid, partially in the classroom, partially at home. There just aren't a lot of schools right now at any level that need to do a lot of construction spending, and particularly at the college level and even at the elementary and high school level, that are all funded by, in the most case, property tax revenue. I think they're holding back on any spending that they can possibly hold back on, because colleges are a little uncertain as to what their true enrollment's going to be, and cities, counties, states know that they're going to have significant revenue shortfall issues. So, uh, educational spending down 3%, highway and street spending down 3%. I just think that's a fact. That's a function of states. Most highway spending is done by states. States know that they're going to have a revenue shortfall issue from income taxes, from property taxes, from corporate taxes. They're three main sources of revenue. Um, so, the one positive side of the construction spending, aside from just residential being strong, and I think everybody kind of knew that that would probably be the case going in, year over year, construction spending was about even July 2020 versus July 2019. July 2019, the economy was smoking. We were having 3% GDP growth. We were having 3+% average hourly wage gains, and uh, nobody had ever heard of the coronavirus. And now we get to July of 2020, where we had the hangover from the very sharp decline in March and April. During that time period, I think a lot of states and businesses, when they were doing any uh, amending to any of their budgets or spending plans, might have very likely said, "We just got to put anything that's not absolutely necessary on hold right now. Maybe we'll get to it in the fall, depending on how all this plays out." Still, when you had July year over year, unch 2020 versus 2019, that's not bad. I mean, I'd take that. So that was the construction spending report. The headline, not that great, but underneath it, year over year, even with a year ago for July, not too shabby. Um, Especially so that was Tuesday. The market was up a Monday. It was up Tuesday. Um, Wednesday we had the ridiculous rally to new highs and almost kind of waved the red flag that okay, now it's getting stupid. Um, but we'll get into more of that at uh, at 7 o'clock. So Wednesday we had auto sales and truck sales for August. 2.75 million auto sales, 9 million truck sales. Pretty good numbers. Those numbers for August were up from July. Again, a lot of people were looking at August as maybe a month when things might hiccup a little bit in the economy. We didn't really see it in auto sales and truck sales. We also, of course, on Wednesday had the ADP unemployment report. I think there's a little bit of an issue with ADP. Now the expectations were for gains of a million, maybe a million to a million two. Private sector job gains. ADP came in and said, well, we had 430,000 job gains in August. Market shrugged that off like no big deal. With it, market was in rally mode regardless of what. Now July was revised. July was also a month when the ADP report came in at a much lower reading than the jobs report 2 days later from the Bureau of Labor Statistics. So the positive thing from ADP was that they revised their July jobs number from up 168,000 to up 212,000. And remember, when we get revisions, we always get revisions to these reports, whether they're coming from private services like ADP, from the Institute of Supply Management, quasi private number, which gives us the ISM manufacturing report and the ISM service sector report. Upward revisions are always a sign that going forward, the numbers, that there's momentum in the right direction for the numbers going forward, because basically what it means is when the initial surveys and the initial data came in and they gave us the initial report, then when they get more data, more hard data, and that comes in and they revise the number the next month, upward revisions means that data point has a tailwind behind it. Downward revisions mean that data point might have a little bit of a headwind that's not being shown up in a lot of other reports yet. So, even though the July number was much lighter than the jobs number for July, the revisions were positive. So we also had on Wednesday, we had factory orders. July came in at plus 6.4%. Again, factory orders, another piece of data that is a full month lag. The factory orders report that we got on Wednesday was for July, not for August. Okay. These are more real orders than surveys, although the numbers will still get amended a little bit or adjusted a little bit. July was plus 6.4%. Consensus was about for plus 5.8%. Um, and June was revised up a couple of basis points to plus 6.4%. It was originally plus 6.2%. So a mild upward revision, but still an upward revision for June. That means when some of the final data comes in, maybe some sales weren't finalized. Um, you know, may, maybe some sales, maybe some incentives were added on after the fact to sales that really took place in June. So that number got revised from plus 6.2 to plus 6.4. And another piece of data on inventories, the inventory to shipments, the amount of inventory that factories, this is a factory orders number, the amount of inventory that factories had on hand to the shipments that they sent out went down in July to 1.4, meaning they had 40% more inventories than shipments from 1.5 the prior month. So some of their current inventories got worked off in July from what they were in June. As inventories decline, those businesses are eventually going to restock those inventories. They're going to remake, reorder the components for stuff they have to make. It's just another sign of potential pent up economic activity for the next couple of months. Low inventories are usually, almost always, a positive forward indicator. Now, keep in mind, July plus 6.4, same number as we had in June. That's after April was down 13% and March had been down 11%. So 6.4 versus down 11%, down 13%. April and March both declined. First, March from February declined 11%. April from March declined 13.5%. Both of them declined at twice the rate that the improvement came back in June and July. So there's still a lot of work to do. The economic numbers look good. We see positive trends. We see not really a stalling, but we're nowhere near where we were the end of 2019 and the first couple months in 2020. So factory orders, July, a piece of data with a full month lag. We'll wait a month and see what comes in for August, although we won't get that till the first couple days of October. It will, of course, be on a 1 month lag. Now, Thursday, of course, every Thursday, right? Initial jobless claims. So this was potentially the beginning of a good streak here. Not for this week, obviously, but for the prior week, initial jobless claims declined by 130,000 to 880,000. Now, remember, we had that one number a few weeks ago that got down to like 970,000, the first number below a million for new claims. Then we bumped up to 1.1 million. Then 2 weeks ago, we came in a little over 1 million. Now, this number, 880,000. It's still way too much. It's still way too many people filing first time unemployment claims, but it's the lowest number since this whole COVID economic shutdown started. Okay. Bear with me with the water, but talking pretty much on the phone all day long to people after being away for 4 days. Um, so initial claims 130,000 decline from the prior week down to 880. I think that during the month of September, you're going to see this number with a 600,000 handle on it, maybe even a little bit lower. Well, Chris is asking a question. Worried about the airline layoffs coming, pilots, etc. Any hope there? Um, it's a double edged sword because there's no doubt that the airlines are just in a tough position. They're running although TSA checkpoints on Thursday were much stronger than the week before. I almost get the sense it's because the Thursday before going into Labor Day weekend. It's a little bit hard to compare to the exact same Thursday a year ago because we were running well over 2 million uh, a day a year ago, somewhere anywhere between 2 and 2.6 million. Now we've been running, in the low fives to the low eights. Tuesday and Wednesday are the low point. Usually Friday and Sunday are the high points. We won't get tomorrow's number maybe till next Tuesday because I don't know if they'll update it on Monday, which is Labor Day. But 880,000, the highest number since the COVID shutdown started. Couple of comments from United Airlines about they're looking to book. They expect to be at 40% capacity by, I don't know if they said the end of September or October or exactly what date they threw out there. But yes, there are layoffs in the industry. International travel, particularly, has almost come to a standstill. There's been much less bump up from near zero in international travel than there has been in domestic travel. Um, so there are layoffs in the industry. It's unfortunate, but there are. Uh, the only positive of that is the stocks have been acting quite well. Uh, the Dow Jones Transportation Average, which includes the airline, has been up until this big sell-off, made very sharp move in July and August from really the 9,000 low, 9,500 level to the 11,000 level on the index, and the very popular Jets, JETS, not the football team, but the airline ETF. Very popular for those who want a pure play in the airline space without the other transportation companies involved. Uh, that's been above 18 now for a few days. It's toying around with kind of a big resistance level at 1835 to 1840. I think it closed at around between 1825 and 1830. But this is something that was way down, had a little move about a month ago, pulled back, and now is back above 18 again. Um, as these airlines, you know, bite the bullet and do some layoffs, it's certainly unfortunate for the professionals that are being laid off. But it's going to help the airlines burn less cash and hopefully get back to profitability. Um, we'll see when, maybe in the fourth quarter. Uh, so yeah, is it a concern? It's definitely a concern, but it's not a surprising event. So it's not something that is like shocking the market when these rolling headlines hit on. um, I think a lot of the airlines are classifying it as permanent layoffs. I know you wouldn't really think a layoff would be permanent, permanent layoffs rather than just temporary furloughing people. But look, their flights, their the number of flights they're flying is way down, and the flights they are flying, a lot where they would normally be flying big 737s, the big planes that have the maximum potential capacity, they're flying a lot smaller planes on those routes. So there's just no way around it right now. But it is a good question, and I do always appreciate the questions. Do you see an airline bankruptcy, American in worse shape? It's potential, Chris. Other thing I would say is for the last 30 years, almost every American airline has been in bankruptcy. I would say once or twice. Uh, Airlines would just have a habit of always ending up in bankruptcy, but you will notice that when they go in bankruptcy, it's not like they halt their activities. They are still they still operate under debtor in finance ownership, or whatever the different classification might be for what the specifics are of their bankruptcy. It becomes very technical and very uh, legal. A lot of airlines have been in bankruptcy from time to time. That's different than being in liquidation. Um, and if one or two of them files bankruptcy, I am sure that they will make provisions before they do so to continue to operate and operate safely under all the guidelines from under all the normal FDA protocols, FAA protocols. So, continuing claims went big drop in continuing claims. Those are people that have been filing for the last 4 weeks, I believe, down to 1.2 million. I'm sorry, down to 12 million from 13 and a quarter million. So that's a decline of like a million two. I just get the feeling that during September we're going to see big declines in both first-time filers and in continuing claims. That continuing claims number could be 800 to 850,000 by the end of the month. You know, I mean, I'm just throwing a dart, but if these trends are real, that's probably where that number's going. That would be a very good sign for the jobs market. So we got a productivity number. We actually got a revision to the second quarter productivity number. Productivity is a big part of GDP. It's basically, if you think about productivity, it's almost like self explanatory. It kind of means how much is being made with how much labor. So, productivity was revised for the second quarter to plus 10% from plus like 7.2%. That is a very large upward revision. That's an annualized rate of 10% productivity. Um, up 10%, 10 from being revised from 7%. Basically, um, unit labor costs did not go. The rate of increase for unit labor costs was 9%, where the initial report that came in at 12%. Uh, it gets very technical and quirky. The labor market has been tight, especially in certain skilled jobs. And I think that there may be a little bit of a play, even that it's difficult to get a lot of people to go back to work when the extra $600. And John, John, we're doing the economy right now. We're going to take a break. Let everybody have a Friday evening beverage of their choice. I've been away for the last 4 days, and then we're going to come back at 7 o'clock and talk about all the a wild week in the stock market. Right now, we're doing a recap of the week's economic data. So productivity revised up to plus 10% at an annualized basis. That's a very high number. It's because of we're coming off a shutdown and quirks in the labor market. I think the labor market was tight when you had that in the second quarter. Of course, the second quarter ended the end of June, and then you had that for most of the second quarter after the shutdown started. You had that added $600 unemployment kicker from the feds that contributed to the labor market being tight. And for those people that really had to hire people, they had to pay up a little bit. But the unit labor cost for this revision of plus 9% wasn't as much as what it was in what they call the advance report or the initial report of plus 12%. Uh, and that is basically on a year over year. That's Q2 productivity for Q2 2020 versus Q2 2019. Now, it's really like there's a big, long arithmetic formula to it. And even though in the second quarter, GDP was down, 32% on an annualized basis from a quarter of a year ago, output was down 37%. Hours worked was down 43%. So when you have hours worked decreasing at a faster rate than output, that means you're actually producing more output with fewer hours worked. And that translates in that big formula they have to an increase in productivity. So output in the second quarter in this productivity formula was down 37%. Hours worked was down 43%. That means they were making more with less hours worked. It's a little quirky. I think what we really got to do is see what the final number comes in at. And I think that the productivity factor could also be very high from a lot of people working at home. Maybe they're working longer hours working at home. Maybe they've cut up to 2 hours out of their commute each day. So they're being a little bit more productive. Even though there are some aspects of working at home that might be unproductive, there are some aspects of working at home that can be very productive. It's very quirky. I'm not intimately familiar with the formula. But the productivity report is typically a very underestimated report as to how significant it is for GDP and for the overall economy. But this particular second quarter, it's almost a one-off. We also, and on Thursday, we had the non-manufacturing sector. We had ISM, manufacturing on Tuesday, strong number on every metric. So for the services sector, usually runs a little hotter than the manufacturing sector. We actually had a little bit of a decline on August versus July. The ISM non-manufacturing report for August came in at 56.9. That was actually a little bit of a decline from 58.1. But I will say that 58.1 for July, that number is hot. You get up towards 60 on these ISM reports, whether it's for the service sector or for the manufacturing sector, and that's getting into hot territory. And you just sense that it's hard to maintain that level. So 56.9, still an elevated number, well above that expansion contraction threshold of 50. A modest decline, but still a strong report. The worst part of that was you had new orders down to 56.8 from 67. Look, 67 for July. That was just a smoking off the charts number for new orders. came in at 56.8 for August. In and of itself, you'd take that any day of the week. It's just a decline from the prior month when the number was really hot because the month before that, we were coming off the depths of the decline. Prices index up, labor market's hot. Not just labor, but also maybe you had a big inventory rebuild in in some items. But this is service sector, so you're not talking hard goods, but you might be talking restaurants charging a little bit more for delivery, but not really carving that price out. Um, 64. That's a hot number for August for prices for the prices index versus 57 in July. Now Friday, the jobs report. I probably could have talked for the whole 45 minutes about the jobs report. It was a very good report. Look, the headline was right on the number. Okay, people were saying the consensus was 1.4 million added jobs for the month of August. I had really seen like anywhere between 1.2 million and 1.4 million. And frankly, I think that after the ADP report came in with a number of a little bit less than plus 500,000, that people were saying, August, I don't know, you know, a lot of we had the outbreaks of the COVID affect a lot of high population areas. You could have had some a lot fewer hirings than people had thought. You could have had maybe some layoffs from people that have been called back. You had states dial back on some of their reopening of indoor public activities. But today came in 1.37 million, and the real stunner was the unemployment rate dropping to 8.4% from July was 10.2%. There were plenty of economists, even part of the National Economic Council, the Trump economic team. They were saying 3 months ago that they hoped we could get the unemployment rate below 10% by the end of the year. It's like this was the August report. Unemployment rate 8.4%. And not only did we have an unemployment rate of 8.4%, we had average hourly earnings come through at 4.7%. 2 years ago, 2.5 years ago, late 17, early 18 was the first time that we could get that average hourly earnings to come through above 3% increase for more than just a blip. And now we got average hourly earnings coming in at plus 4.7%. And not only that, I'm hoping I have the piece of paper that I really want in front of me. I probably don't. Look at this. I do. Not only that, but you had 250,000 ads in retail jobs. You had 175,000 ads in leisure and hospitality jobs. Those are not high-paying sectors. A lot of leisure and hospitality jobs are bars, restaurants, hotels. And in fact, of the 175,000 increase in leisure and hospitality, 134,000 of those were in the category, and it really is a category on the report, drinking places. Okay. Obviously, that means bars. So those are not high paying jobs. I mean, those people are making below minimum wage because they're getting paid on tips, et cetera, et cetera. So for average hourly earnings, 4.7%, unch with what it was in July. That's an annualized rate. That's a strong number. That's a very positive sign for the economy. And you had the unemployment rate at 8.4%. and you actually had an increase in the labor participation rate. So the labor participation rate increased to 61.7 from 61.4 in July. That means of all the people that are potentially employable beyond a certain age, but not yet uh, probably retired, or beyond a certain age, maybe they say if you're over than, you know, 80 or 85, maybe you're not employable. I don't know what the cutoff is on that. So when you have a labor participation rate increase, and a 0.3% increase in the labor participation rate, it is a lot. That's a big increase. It usually moves a tenth at a time. That means that there's that many more people in the workforce. And typically, what that does is that hinders the unemployment rate from dropping, because you got that many more people that have joined the workforce because they hear that the job market's getting a lot stronger and maybe they haven't looked for a while. So you got an increase in that. And you also have a drop in the unemployment rate from 10.2% to 8.4%. There was just nothing in this this employment report that people could really take issue with. Now, it came into the teeth of the morning after a market that had had a well overdue sharp correction. And we're going to get into this at 7 o'clock. But as people write about it over the weekend, and I know it's a holiday weekend, but still, there's going to be a lot of commentary on this report and just positive data point after positive data point. I had thought that August might be a tough month for the employment report. But it came through well. I mean, look, we had plus 29,000 manufacturing jobs. Not great, but it's plus. Goods production plus 43,000. Retail plus 250,000. A lot of stores opening up after having been closed for a long time, maybe even to just help with online orders or ordering online and then picking up. Professional business services plus 200,000. I'll get back to that one in a minute. It's a very important number. Leisure and hospitality plus 175,000. 135,000 of those were from jobs at drinking places. I would imagine that those are places, a lot of them in the heartland of the country. Probably not California, where they're still restricting indoor dining. Probably not New York or New Jersey. Today was the first day for indoor dining in New Jersey. I think at either a 20 or a 25% capacity restriction. And of course, Governor Cuomo tried to close every loophole he could so that those restaurants that were serving outside could not be just serving drinks in the state of New York. 3 high population parts of the country. So this had to be a lot of other places where they were allowing bars to reopen. 135,000 job ads there. In terms of the demographics of the employment picture, black unemployment declined from 14.6% to 13%. Still way too high. Still much higher than it was before all this started. But it's a significant drop. Maybe we get, a 2%, another 2% drop out of that next month. Hispanic unemployment declined from 12.9% to 10.5%. That's still too high. It's still a lot higher than it was before this started, but that's a pretty good drop. I got to think that the economic team at the White House was very happy about this report. Now, I mentioned one other item in here. Leisure and professional and business services added 200,000 jobs. Half of those were added by temporary agencies. Temporary agencies are people that pre-vet workers that are maybe going to be temporary workers. That businesses say, well, I need somebody for a month. I don't really want to hire somebody full time right now. So they go to a temp agency, and they call up the temp agency and they said, I need 4 people for the next 3 weeks. Might be extended for another 3 weeks. I just, I'm not really sure yet. Okay. So the temp agency looks at who they have in their system. They, you know, send 3 or 4 people over. Let me know if these people work, et cetera, et cetera, et cetera. Of the 200,000 jobs added in professional and business services, half of them were hired by temporary agencies. There are the two biggest leading indicators for job hiring in the next few months of any cycle are are overtime being paid and temporary employment. Because if the business then senses, if they're starting to rack up their hours of temporary employment, and believe me, they pay a fee to these temporary agencies. These are not nonprofit organizations, okay? These temp agencies that send workers to companies that need jobs, that need employees, maybe for a month, maybe for 6 weeks, maybe longer than that, but they're not really sure. Maybe for 2 weeks, maybe for the week of Thanksgiving, maybe for the holiday shopping season. That was always the thing in retail. It, if businesses see that they're racking up fees with temp agencies for temporary workers, or that they're paying a lot of overtime, they will turn those jobs into permanent jobs. So, what we want to see next month is how many of these temporary how many of these jobs from temporary agencies become full time jobs, because that could be an additional kicker to the jobs report going forward the next couple of months. This was the August jobs report. We will get the September jobs report in uh, the first Friday of October. That's the last jobs report we will get before the election. The election is the first Tuesday of uh, November. And the way the calendar falls, we will get the October jobs report on the first Friday of November. That falls after the first Tuesday of November. So the September jobs report that we get the first Friday of October will be the last jobs report before the election. Okay, this is the Anderson report. This was game one of a 2-game doubleheader. We're going to come back at 7 o'clock and we're going to go over a wild week of volatility in the stock market. There's plenty to talk about. I want to thank everyone for watching. You can obviously always watch on replay, but if you are new to my broadcast, this is my YouTube channel, The Anderson Report. I also go out on Periscope, TJ Anderson 12, and my Twitter handle is TJ Anderson 1. If you have questions that you want me to address at 7 o'clock, shoot them into me on Twitter. Shoot them in the stream here, or join the broadcast at 7 o'clock and shoot them in then. We had a very, very sharp decline in the market on Thursday, a relatively decent rebound off what would have been a second very, very sharp decline. Just food for thought. And we'll get into it more at 7 o'clock. The NASDAQ Composite Index at one point in time, intraday, and again, we only talk about it's the closing prices that matter. But the intraday, the NASDAQ composite was down 9.8%, given from a very, very high level, from a really extended, overbought, all-time high close on Wednesday. But 10% is considered a correction. Sometimes it's a buying opportunity, frankly. We got that to down 9.8% today. All right. That's an hour on the economic data. We're going to come back at 7 o'clock and talk about the stock market. I appreciate everybody for watching. Please subscribe if you haven't. Hit the like button. Share it with your friends. You're not going to see content like this really pretty much anywhere else. We will see you hopefully at 7 o'clock. If you have plans Friday evening, that's very understandable. You'll be able to watch it on replay. So everyone, have a great Labor Day weekend. I will, after the 7 o'clock show, I will probably broadcast again either Sunday or Monday. But we'll see you in an hour.